Now we should be recording. Okay. Welcome. Happy Thursday. And it is October, I had to check, October 23rd, 2025. At least today, I don't have to check my name. I'm Tim Quast. Good to see you. Some days I do. And along with me today, as usual, is Brian Wilson, market strategist. So thanks for joining us. Happy to have you here. I drew the short straw to go first, I think, right in the rotation. Am I right about that, Brian?
Okay. That's right. Yep.
Okay. So that way, you could actually go do something else for like 15 minutes and then come back for the valuable part when Brian covers what he's going to cover. Don't mind it. We always have a sense of humor about stuff, you know. So I have four things that I want to talk about. First of all, volatility. You know, I think about this all the time, that I think people don't focus on the right stuff. Now, how would I know, right? That could be construed as an arrogant thing to say if you say, well, people aren't focused on the right thing. Well, you think about how the market works, which is what we spend our time doing. I'm going to share my desktop. I'll come to that little image. I wanted to share it, and it was on a different machine. But to us, everybody comes up with a method to do this. So we have to. I want to come to this. But we think about demand, supply, and volatility, and I'm going to focus on that first. And then broad sentiment, context, divergence. Right? Those are the big six things that we're always looking at, and we do it for public companies. Had a conversation with, it's no secret, Ford is a customer of ours, and we were talking about the incredible volumes that we're seeing. Before noon today, Ford had traded 170 million shares, and so they're averaging 200 million shares. Let's call it close to 200,000 trades a day, 180,000 trades a day. Better than $2 billion of dollar volume a day, and it's just there's just one little example. If you look at the broad market, I saw that Goldman Sachs had a note out today about the market trading 25 billion shares a day. So $1 trillion of notional value. There's a lot going on. And what is responsible for that? I mean, is that a reflection of fundamentals? Well, fundamentals meaning business performance. And I will always say that the market reflects whatever its principal purpose is. Well, what's its principal purpose now? There are 130 stocks with 75% of the market cap, and they are generally central to thousands of ETFs. I mean, at least two. There are 4,100 ETFs that trade in the U.S. Equity market. Half of those are domestic equity focused. There are over 3 million global index products. There are options that trade on stocks, ETFs. There are futures that trade on indexes. So, if not hundreds of thousands, could be millions of derivative products if you included what's over the counter and what's exchange traded. And that is what's occurring in the market. It's not business fundamentals. It is the relationship among those things. Therefore, demand, supply, and volatility matter. And here's my observation about volatility and why it's important. I'll get to the platform here. If you look at what's happened, at last I checked, I'll just focus on the S&P 500. So let's say it's up 70 basis points, 50, 70 basis points. I don't know what it is. It will be important to me if it was down more than 100 basis points intraday yesterday, and it finished down 53 basis points. What do we talk about all the time? That the broad measures, you could use, the S&P 500 is a futures contract, so moves about 1%. So SPY moves about 1% intraday between the highest and lowest prices. And so it's what we use to trade. So if we closed down 50 basis points yesterday, you could look at it and say, well, that's not bad. We know that's kind of in the middle. That's mean reversion, getting back to the mean, because all of that stuff, that's what it's about. Ultimately, everything needs to track each other. If there are, ETFs are derivatives of underlying stocks, they need to track the stocks. If derivatives, puts and calls, are representations of the prices of the underlying securities, they have to some degree track them. All of that becomes the purpose of the market if it's the prevalent activity. And we say 90% of volume is something other than fundamental investment. So if you understand that, then things begin to make sense. So unless we'll see, I don't know what it's going to do. We'll talk about broad sentiment here. I'll cover these six, but I'm beginning with volatility. Always keep in mind that the market has a propensity to move 1% intraday, not where it finishes. It could finish 10 basis points changed. There was a period, from call it June to September, where the market was moving about 7 basis points. If you went closing price to closing price, reference price, how it closed relative to midpoint price, it was kind of amazing. I pointed out on CNBC that it comes from a note that I wrote here that we took part of that, made it a quant blog entry at Interactive Brokers. I talked about how the market had been in the same band between, it hadn't broken below 5, nor risen over 6 for a very extended period. I don't like to say, well, this is the longest period since, because I'm not sure there's any meaning in that. But in that instance, I said, well, it's the longest period since 2018. Pretty long time for the market to do that. And then everything changed. And it's key to understand important. The key to it is to understand volatility to me, because volatility is the reflection of that relationship. You could just say equities, ETFs, and derivatives. They all have to track each other. If tracking breaks down, the entire model is threatened. So coming back to finish my thought, if the market is down 50 basis points yesterday and it closes up 50 basis points today, but intraday it was down 100 basis points, that's not good. That would tell you that underneath the skin of the market, probably money's trying to get out. Money tries to get out. What kind of money? Money in the basket of stocks, money in the ETFs, money in the derivatives, the money that creates demand. So we look at those things. I don't fixate on it, but you certainly want to know what the trend is in it. And so we watch all of those things. That volatility is essential. Instead of saying, well, it's a great day for the markets, so everybody is happy again, and it's about corporate earnings, blah, 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 blah. Well, is it? I think Brian wrote a really good note about how the market had moved 0.00%. If the market is doing that in a market where there are relentless inflows into passive instruments, because we all make contributions to our 401ks or whatever, and that money has to get deployed. By the way, Vanguard is half of all equity assets. Morningstar article, I shared it with the team today. I mean, it's astonishing, the concentration. Well, then if we aren't moving, and it's around options, expirations, context, and I'll walk you right through all six, that's probably important to know. And you say, well, how am I ever going to keep up on all this stuff? It's very simple. It's not hard at all. There are 6 things: supply, demand, volatility. The relationship between demand and supply creates volatility. They're a reflection of what's occurring in the market. They're stocks. Most of the money is going into ETFs, which have to track there's like a collateralized currency, have to track the basket. The basket's going to change. And then the derivatives from those. They're options on both stocks and ETFs. Plus, you got all kinds of leverage in there. Just unbelievable amounts of leverage. And that's what is creating this tremendous amount of trading activity. It becomes a calculus problem when there are 3 components. It's addition and subtraction when there are 2. And so you get compounding volume because the same underlying set of securities supports an expanding cloud of other things. And that works just fine until it doesn't. That's why we watch things like this. So, top to bottom, here's demand, here is supply, and volatility in this measure averages about 1%. When it breaks down, that gets our attention. And we're going to watch to see what happens through context. There are options expiring. Did it affect that great cloud of derivatives? This is the first day clear of the October expiration cycle. VIX instruments, the new one traded yesterday. So are we out of it one day out? Well, Thursday, Friday, we'll see. Uh, so that's context, and then we look at the divergence between demand and supply to know what to trade. I'll come back to that with the model portfolios, but just look at this. I don't know if this is good or bad. I can make the case that it ends, and I can make the case that, as I've said before, that it could be bad. I don't know. One does not know what's going to come. You can only, to the best of your ability, be prudent, look at what the data are, try to make good decisions about what those data reflect. So if you look at this period, see this right here? That's the weak demand curve. Now it's bottoming. You come down and look at supply. It rose. It's normal 5, 6, 7 days. Sometimes it runs 9, and then it has pulled back some. But I don't know. Has it stopped falling? Falling? I don't know. But that's a convergence. The market hasn't done a lot. It's stayed kind of flat. We expect that. Right? It's mathematically very predictable that condition will exist. So then you go, well, where did that happen in the immediate trailing data before? Well, it happened here. You had rising supply, and then it moderated, and demand fell and bottomed. And what did the market do right around options expiration? Well, it was flat, but it didn't really do anything. We had one volatile day, just like we had one volatile day here. This is very much a product of arbitrage. If there are gaps that form, machines go to close it, and that can be profitable. But it also can affect the math. You go back to December of last year, and it's what caused us to go, well, the market could get clocked. So the other time this happened was here, right here, in March. After the February expiration cycle, there's that same dip, and we plunged. Now, I don't know. You look at this and say, well, it's not the same. It's never going to be a mirror image. It's not the way really anything works. There are only similarities. You look for similarities in the data, and maybe they tell you things. All I know is that this is the weakest the demand has been since here, where it recovered quickly, and here. And I don't know that question has been answered. I don't know. Certainly, you look at the supply side, comparable. I wouldn't say they're very different. Here, that not a big tell, but that's what you think about. Right? And when you think about broad sentiment, context, and then divergences, kind of helps you understand where to go. I look at those things all the time. So, Brian had concluded, I might do the same, that we're back in the low volatility portfolio. Let me go over here and I'll pick that up really quickly. So if we look at the model portfolios, this is why we put it on there, right? When you look at the data, we can see, okay, well, there's kind of a breakdown in the momentum pace. We want to have an alternative. I mean, if you have to switch horses, you need to have another horse to switch to, right? So this continues to perform pretty well. You go back to that period where the last time we had weakness, there was here, and then there was in August, right? So in August, we had the same sort of, little hiccup in the behavior, but then we were off to the races. Oh, it could well be the case. I don't know what it's going to do. You go back here, and it fell off the cliff. I don't know. But certainly the low, and we don't calculate low volatility necessarily the way that you see conventionally. We are looking for 5s with basically market tracking volatility, maybe with a little wider margin on it. But that's how we think about it. It's the core money. Might differ from somebody else who's running a low volatility portfolio, and we're fine with that. We're running quantitative market structure portfolios. That's what it's predicated on solely. Then if you come and look at, I'll click that just in case. This is the momentum portfolio, right? And we're all watching this stuff, and it has just gotten clocked. So you switch horses, still way above SPY, but that is a dramatic turn. It made a dramatic turn here. In August, it did not. It dipped and recovered. Well, that hasn't happened. So I don't know, but I look at what would you conclude? So I always say, well, you look at the data and you say, well, is the data the same or different? Well, there's a bunch of different data now. That's all I know. And unless and until that data improves, I look at this and say it still would suggest there is risk. And I'm the kind that always looks for it. You say, well, Quast, you're always Dr. Doom. You're always, are you ever happy with condition? Well, of course. I mean, there have been multiple times where I took advantage of these data, and of course, momentum was slow to reflect the opportunity right here to buy that big dip, which I think a lot of us did. I did, Brian. We all levered long into it because of going back here to broad sentiment. When you look at dropping below the green line, the entry point, when it does so dramatically for the first time in a cycle, it tends to be the beginning of something. When it does so for the second, could be the last time, or third time in a cycle, it tends to be the end of it. And here, this is a dramatic breakthrough below the green line, and we all went, well, that's going to be a buying opportunity. And you would say, well, why would you look at that differently than what happened back here? Back here was the first breakdown since 2022. So that's an indicator, like, okay, well, something's beginning. And then when we got here, well, there's probably something ends, and we haven't gotten to the beginning of something else yet, so I don't know. But that's why we look at those things, and it all comes back to me, what's very simple is demand supply volatility. If the volatility trend changes, we look at it. If the demand trend changes, it absolutely has. It's not the same. It's certainly not the kind of demand that gave us this great run. We had a pounding momentum run, and it's run out of steam. Now, maybe something gives it a boost. Could be that the Fed, which is likely to cut rates again next week, is that the 29th, I think? Maybe that's it. I don't know what the catalyst is that could restore that kind of momentum, but it would take one to do that. And so that, I think about those things all the time, and we'll talk about what's next, so we can do that collectively together. That's what I've got to cover. I'll hand it off to you, Brian, unless there are questions.
Alrighty.
Nothing. Well, but I was hoping to engender a bunch of questions. It's usually bad when you don't, right? It's good to see a bunch of questions.
I'm sure we'll get a few here towards the end. 3 or 4 topics for me, kind of goes right hand in hand with what Tim was covering on some of the points. It's kind of one of those periods where it's certainly an interesting period. I wanted to first start with tariff drama 1 versus tariff drama 2. So if we look at what happened back in April, obviously the market just got absolutely clocked there for a period of time, and this was about a 3-week time period from 4/2 when the market started coming under pressure to when we finally got some relief, oversold conditions, market rallied from that. It was 4/21. So that was a good amount of time where the market was really choppy. Let me bring this look back to an easier one to see. So far now we've gone from 10.8, 10.9 up to 10.22. So certainly not as long of a period, but neither was the decline. And Tim and I had mentioned this in a meeting that we had on Monday morning, that I was concerned about VIX expirations, because whenever central tendency here, when volatility gets introduced shortly before expirations, it tends to introduce volatility at VIX expirations. It just does. So we got that once again yesterday, and then it becomes a question of, do we have the all clear now? And Tim did a great, point of covering some of those elements. So I won't get into that, but you can see a little bit of the difference between the two, where it took longer in April to come out of that volatility period. And if we do have the all clear now, it would make sense that it comes after VIX expirations. And just as a reminder for those who aren't familiar with the calendar, you can find this on our site itself, we try to cover this right here under resources, the expirations calendar. And what we've been walking through recently differs than the normal calendar. And what I mean by that is if you look at November, November is a great example. You can see the reference down here. The gray is regular expirations. The green is VIX expirations. Now it normally lines up in a Wednesday, Thursday, Friday cadence. That's the normal way the market runs. Once a quarter, it looks something like this, where you have expirations Thursday and Friday, and you don't have VIX expirations till the next Wednesday. The point is, it's very difficult to really get a clear look at market conditions until you clear VIX expirations itself. For many of you who track our portfolios, so this is our current names in our, and I'll show you what I'm looking at here. So I take the daily trading ideas, for instance, and I sort them by probability. And that's the way that they appear on my list. The last 3 days, there was just a sea of red in these names. And a lot of those names, if you were tracking it, some of those were down 11, 12, 13%. It was really ugly. Why was it that ugly? Well, if you look at these names, you can look at the intraday volatility. If you look at BE, it has intraday volatility of 10.5%. So the potential is there that name can lose 10.5%. It's part of the reason why I stay away, especially when expirations ends and we shift our focus to the new series. I tend to stay away from overnight positions. Why is that? I don't know what these names are going to do. I know what they did at a point in time. Here was the point in time. I know what the strategies were going into the end of the 17th. Will they have the same type of strategies as the focus goes to the next series? I don't know. And clearly there for a couple of days, they did not. They were getting absolutely clocked. That was part of the reason that Tim and I advocated going to cash for a period of time in our momentum portfolios. And let me show you what that looked like. If you had gone to cash, so you can see this is our momentum portfolio, model portfolio. For a while there, we were up 49, 50%. And, we lost 10% over the course of about a week and a half or so. So performance was very, very difficult. And we had advocated, potentially going to cash. I know Tim and I both did in the model portfolio for that very, very reason. We were coming through expirations. We didn't know what was going to happen coming out, the other side. And if you, look at that performance chart, that's what we missed right through there. We missed that downside, which I'm very thankful for. But, that's part of what we're looking at. We look at the context of the market. We try to, tell you about that. But you can also look that up for yourself. And once again, it's on our website under resources. I mentioned yesterday that, more than likely there was a good chance of having kind of a continuation of a slow churn higher against a low volatility environment. Why did I use that term? And Tim mentioned it already, just that kind of slow movement higher. If you look at, where we've been, let me back this up 6 months or so. It's just very consistent, moving higher, moving higher, moving higher. Obviously, very rapid move higher came out of April. But if we look at the backdrop in terms of volatility, and I try to mention this in my notes, this is an IR report, investor relations report that I'm referencing here, and this is the ETF side of things. This number was even lower on a 50-day basis. I think it went down to 70 basis points, if I remember correctly.
Even
There's the
60. I
north,
think it went down to
60
60
basis
even.
points. Yeah,
Maybe.
yeah.
Yeah, at least for a period there. Yeah.
Yeah, absolutely. The point is it got cut in half. There's your 200-day average. Intraday volatility was so extremely low for a period of time. And you can see where we've been during the last 5 days. We went through that volatility surge. Volatility returned to the market. Are we fully out of it now? I mean, yes and no. I'll show you what it looks like right now. So this is the SPY. Here's the volatility surge. So it was 3.2% on the SPY. And back and forth we went for a little while, and it's starting to settle down a little bit. 1.270 all the way down to 50 basis points. 1.3 yesterday. Recall that was VIX expirations yesterday. So we have had a period here, slow churn higher in a low volatility environment. Now, as we move past VIX expirations, what's the setup right now? It's pretty good. As we look at all equity portfolios, sentiment starting to point higher. Dow Jones sentiment starting to point higher. Large cap sentiment starting to point higher. Magnificent Seven sentiment starting to move higher. You kind of get the point here. I'll share something interesting. Take a look at small cap. I showed this to Tim yesterday. Look at that period of extreme short covering. Guess what that did in the broad market? I think I have it up. So this is S&P 500 in blue, small cap in orange, and look at that period of outperformance. So the data was right on, and this was right ahead of options expiration. So everyone covered shorts in small cap, but sometimes that can be very predictive. If you see something like that, what's happening in the market at the same time, pays to pay attention, to those things. You'll hear me mention this almost every single time, but when we look at April compared to now, I'll have to back this up for a moment. So obviously the April downturn that we had in the market, the period of volatility that we had now, I've been closely watching, what's the big tech setup? And I mention this almost every week because I think it's important. If we circle back to big tech in April, let me find a quicker way to get there. So here's 5-day sentiment in that period where the market started to deteriorate, and look at that market performance there for a couple of days. Look at what was happening with big tech behind the scenes, just absolutely collapsing. So fast forward to now, in fact, big tech got all the way down to 1. You have a buying opportunity when big tech, gets down to one sentiment. We fast forward to now, as we came through, and here was the tariff drama, down 2.7%. Look at how we were positioned going into that. 5.7, 5.7. We were pretty strong. It didn't mean that we weren't going to be choppy for a period of time. We were, but at the same time, we remained pretty strong. Were we going to continue with that strength as we came through expirations? That remained to be seen, and it was a little bit of a question mark, really all the way through. You can see how broad market sentiment continued to weaken. Behind the scenes, big tech got down to 5, and it's now starting to rise again. Are we fully all the way through? As Tim mentioned, you never know this for sure. But if we look at big tech, I think that's providing a little bit of stabilization. One other point to mention on the previous report that I showed you. So once again, this is on the SPY. And I think part of what we've been seeing the last few months is just an absolute, let's call it whittling of volatility with fast traders getting in the middle. And here's what I mean. Here's the normal levels for SPY, the four behaviors. This is the levels of trading in a day. So for instance, if you traded 100,000 SPY, active money would trade 10,000 of that, and so forth. But you can see that passive money is actually declining a little bit, fast trading gaining more influence. And essentially, we've gone a period of time where there's just been limited sell interest in the broad market. And investors aren't selling. Fast traders take that cue. They're like, okay, there's no sellers out there. We'll continue to slowly move the market higher. Central tendency for fast traders, what would they like to do? Put less capital to risk. So they're going to whittle trades into smaller increments. That's going to mean that there's greater trading volume across the market, but recognize that a lot of that trading volume just ends up being fluff. It's 55% of trading just with the machines going back and forth, capturing portions of a penny, and doing that repeatedly during the trading day, and it whittles intraday volatility, much lower. I did mention this morning, I was a little concerned about possible canaries in the coal mine, as it were. What were we looking at? Well, once again, we were looking at just a demolition of the momentum market during the last 3 trading days. Did we see tremendous changes there? Was something afoot? We saw it with gold a couple of days ago, where gold just absolutely got clocked as well. And you look at some of those things, you're like, okay, is this a temporary trade? Is capital coming out? Are people having to raise collateral and they're taking their winners at the beginning? So that was, part of what both Tim and I were trying to process is something going on? And once again, we saw that playing out in the momentum portfolio itself. This section right through here where, momentum was just coming under a tremendous amount of pressure. Kind of going full circle here. If we look at, we're in the middle of the third quarter, you have to keep in mind, what are market participants doing? Well, active investors, as a general rule, are going to be behind the scenes or be an underperformer. What does that mean? They usually have to be making up space. So we look at what has worked year to date, and this is I find this tool really helpful. It's a sectorspiders.com. I use it every single day. But if we look at what has worked year to date, well, some sectors have worked much better than other sectors. Communication services up over 19%, tech up about 23%, and there's some laggards here. Consumer staples has done absolutely nothing. Energy hasn't done very much. So as a general principle, what are people going to be doing? Probably pursuing what's been working so far during the year. What's been working? Well, tech, communication services, that's your big tech portfolio. Low volatility has been working as well. And momentum has been working, right? So when I think about those things, how am I going to approach trading? Well, as we moved past VIX expirations for the time being, and I mentioned this morning to those who get the portfolio, I went back into low volatility today. It doesn't mean I won't go back into momentum. I might go back in tomorrow, to be honest with you. If we look at what occurred here in August, we previously saw a downturn, not quite as sharp as this one, but we went from 40% down to about 35%. And then we quickly rose by 15% after that. There's no reason that something like that couldn't happen again. Could we continue to get clocked? Of course, anything's possible. But if we look at what's happening behind the scenes, we do see that strength in big tech that would generally support the momentum portfolio. And as I mentioned, right now I'm in low volatility. I thought it was just a better place to be at this particular time. But I'm not opposed to going back into momentum. And as I mentioned, I might even go back into it as soon as tomorrow. I think that's it for me, Tim.
Sorry, I had to unmute. Yeah, I was looking at the portfolio components. The interesting thing is um, the low volatility portfolio picks up big tech because
Mhm.
the big tech is large cap blend. It's value and growth. It can possess momentum characteristics and it can possess value characteristics. And it gets back to my central point. The same stocks underpin everything. You cannot escape it. I think I mentioned here, and I have done it a number of times, that the weighted market cap of the Wilshire 5,000, there aren't 5,000 stocks in it. There are 3,200, but the weighted market cap of the Wilshire 5,000 is $1 trillion. And you say, well, how could that possibly be true? Because everybody owns the same stuff. There are 11 stocks with $1 trillion or more of market cap, and everything is exposed to them. So to Brian's point, that's why we have a big tech portfolio, and we have a couple of like I would call them the remora fish of the big tech that we include in there, including AMD, with whom I have a discussion tomorrow, by the way, about market structure. The the uh, the reality is everybody has to own it. So as it goes, so goes the market. And I think Brian's making a very good point. Again, you just look at the probabilities. What are statistically, probabilistically, what are the outcomes? Dan, I was going to answer a question of yours. Um, that I was going to point out. Maybe I should do this. Let me share my screen really quick. I will not belabor this point. I want to be respectful. We took you long last time, but I do think this is a good point. You said, well, why would one time be different than another time? Why is this time different than this time? Why would you look at this and say, well, that's trouble? And it's because of when demand breaks down after a long period where it hasn't, it will tell you that there is a change. What change is it? Well, we could construe all kinds of conclusions about it, but it would suggest that people's posture toward making commitments to equity investments, in this case, has changed. It's like this long run, the whole pandemic market, there's a little touch in back here. We did have a little, we broke down, but if you go to here, this was the deepest. Now, this is the deepest since then. And so you look at that and go, well, maybe that's an end. And there's another feature here. What happens is you have very strong tops. This is a momentum market, and then it gradually loses steam. It's a very characteristic nature of everything. It is it's the law of inertia. It's the law of entropy. There are principles of thermodynamics that manifest in the equity market. And then in bear markets, you don't get that. You get a lot of white space. You get big moves. The market moves a lot in bear markets, but it doesn't have that sustained demand that you see here. So then when it breaks down, that should get one's attention. And so that's what you look for. Same thing here. Big demand. Then we get a little breakdown. Demand slowly deteriorates, and then we have a big dip. Okay, well, there's your signal. Now you want to be careful. And so here you say, well, this is a much shorter cycle than either of those. I agree. Um, but as we get more and more derivatives in the market without an underlying expansion in the large liquid securities that the market depends on, the cycles may shorten. What was true before will not be true today because there are thousands more of those things. On September 3rd, Coinbase moved from permitting 50 times leverage to 200 times leverage in Bitcoin and Ethereum. You get that. There are now 5 times levered ETFs that the SEC has apparently approved. I don't know why they do it. I don't know why you would stuff a market full of derivatives. But just look at this. We had a very strong demand, and now demand has petered out, and we haven't broken below. for. I mean, that's certainly going to be very important. Hasn't happened yet. I don't know when it's going to happen. Statistically, it's not going to happen this time. Right? It's not the, so you would say, well, it's probably not the end, but I don't know. It's not, I don't know that it's going to follow the same pattern that it did before because there are different things at work. It can happen all of a sudden. You could have a little bit of recovery, you have a little bit, and all of a sudden, boom, it falls. I don't know. That is a product of derivatives. How does Molina Healthcare lose 20% of its market cap? Very simply, 20% of its market cap is tied to derivatives. If everybody had just committed to derivatives positions and they report results and immediately somebody dumps their basket of derivatives, it takes all of it gets marked to zero. And that principle applies in the market all the time. I want to show you one other thing and then I'll shut up. This is to me interesting. That's all. I share interesting things. There are core things, 6 core things: demand, supply, volatility, broad context, broad sentiment, context, divergence. I mean, don't have to know everything. Those reflect everything that's important to know. But I find these things interesting. I realize it's a little blurry because I expanded it beyond the size that it should be. But what this is showing us is the price of SPY. This is just a year, basically. And then the short volume in the stocks comprising the S&P 500, and then the short volume, which we track. This is broad sentiment. Effectively, those two we just calibrate. We can use a 10-point algorithm to calibrate demand. And then you have short volume in SPY, a single security versus 500 securities. So the one is going to move a whole lot more than the other. But there's something very telling here, that because money is flooding into ETFs, you naturally have to short the ETF more than the underlying security because that's the inflationary item. The amount of ETF shares expands at a pace of over $100 billion per month. It's astonishing, right? So in order for the stocks and the ETFs to track each other, you're going to have to short the ETFs furiously to keep them from just running away from the basket because there's just so much supply in the market. At some point, it resets because if you keep increasing the supply of currency, everything inflates until it deflates violently. And that's what the central banks try to offset. They try to offset violent deflation. They don't care about inflation. That's not the risk. The risk is deflation. Things deflate, prices drop, then you have to cut jobs because the price of the goods you're selling has deflated. It's the whole model is backwards, but it's the one we have. That should not be the way that economic systems work. It's a terrible model because then you start counting inflation as growth. And you become all concerned about whether prices drop. Well, falling prices are great for consumers, right? If technology improves, prices should come down. I've used the Ezekiel Baker rifle rule. In 1800, Ezekiel Baker sold rifles to Napoleon for $100 a rifle. And in 1894, you could buy a Winchester Model 94 repeating rifle, outstanding technology, for about $20. Right? It's a tremendous deflation because of technological and distribution improvements. So that should play out. But the point out of this is it's interesting when they align. Furiously trying to keep the ETF from running away from the basket. And it took both, right? You have this tremendous covering in the basket. That happened in July, and a huge spike in SPY. And the price went up, but it didn't furiously go up. What's interesting right now is they're perfectly aligned. Right? So what does that mean? Well, it's a very temporal condition. But when they align, which way do you trade? I mean, if you're Jane Street, making a market in a big basket of ETFs and an underlying basket of stocks, and you're long and short to make sure that everything gets to the reference price, and you take a tenth of a penny from everybody and make $20 billion, really good business. Wish I was in that business. It's interesting. It feeds into what I've been saying. The volatility to me does not indicate that money is coming into the market. The patterns don't indicate it. The supply relationship doesn't indicate it. And yet the demand supply relationships look okay. That's why I'm a little bit cautious here. Right? There's discordance, just like there are a bunch of canaries. None of them have died in the coal mine, but there are canaries. There's suddenly First Brands goes broke. Tricolor goes broke. All of a sudden, Western Alliance and Zion's Bancorp and Jeffries, they all get clocked. They've all got bad loans. Tricolor is a big subprime lender. Um, Bitcoin drops as much as the 1987 crash in equities. I mean, there are a lot of canaries out there if you look around. You look at all of them and go, or you could use the old, you hear a knock in your engine and your response is to turn the radio up. It may not be a great idea, right? So I look at all that and I look at these things and it makes me cautious. I look at the performance of the momentum portfolio. Better to be in low volatility, certainly. But I'm a big risk taker on the one hand, but I look at the data and go, that makes me. Oh, gold. That's another one. Dan, right. Gold. I mean, gold dropped the most in 12 years. It got absolutely clocked, and people will say, well, there's no relationship between gold and inflationary currencies. No, it is the way they work. Right? When currencies are devalued, then risk assets rise in value, and then people need money. So they sell the overvalued risk asset and it declines. There's a very normal outcome. And so that's what happened. Where else might it occur? Well, equities and fixed income. I'm not saying it's going to, but these are the things I think about. So, we'll just have to, I just would urge caution. Like we said, be careful about momentum. Said this a while ago. And sure enough, that proved to be correct. Be in low volatility. Realize that I think this is still a risky period. Next week, Fed meeting, month-end options expirations. I would like to see us get a firm footing, and you can always, like the old cowboy saying goes that, the quickest way to double your money is to fold it over and put it back in your pocket. And there are times when that's a good idea. I'm still cautious, perhaps a little more so than Brian. The data will tell us. I mean, you can't miss out. You only buy things at a good price and sell them at a good price. That's all. There's no such thing as missing out.